Hi guys, Max here, and this is of course your market update for yesterday, which was the 26th of May, of course. As you can see, markets were actually really strong. We saw another big rally. That's now 2 days in a row, and actually the last week stocks are up on the whole, so things are looking a little bit better. As you can see, it was green across the board for the most part, in particular around tech stocks. We have Amazon and Tesla going up by 4 and 7% each there. We actually saw Facebook go up by 4% as well. Consumer defensives did quite well. Financials did quite well. In general, it was a pretty solid day for American equities in particular. On a whole then, the S&P 500 rose by 0.2%, while the Nasdaq outperformed, it being tech heavy, and rose by 2.7%, and the Dow Jones, being a little bit weaker, only rising by 1.6%. Across the rest of the world then, did we see a similar trend? Well, we did. We saw stocks rise for the most part, but not by quite as much as in the US. The FTSE 100 rose by 0.5%, the Stoxx 600 rose by 0.8%, and so on the whole, the MSCI World Index rose by about 0.8% for the day, a very strong rally and far, far better than we've been having in previous weeks so far. Now, in the world of currencies, there actually weren't any major moves. The US dollar spot index was pretty much unchanged at all, and the euro and the pound haven't really moved much at all either. The euro is currently sitting just below $1.07 a piece, and the pound is just sitting below $1.26 a piece as well. So this seems to be a pretty stable level that they've settled at, and it doesn't look like foreign currencies are going to continue to depreciate at this time. Now, in the world of fixed income assets, in the bond markets, again, we saw another decrease in yields across the board, in particular in the US, of course, with the US 10-year Treasury yield falling by 3 basis points and now sitting at 2.71%. The German 10-year yield fell by 5 basis points and the British 10-year yield fell by 4 basis points. So we just saw continued flows into the bond markets, even as risk on assets actually performed well, simply because sentiment is changing, investor confidence is changing, and this is just that flight to safety that people were expecting for a long, long time. So is there any bad news? Well, yes, there is, and sadly, it is once again about energy prices, and in particular about oil prices. Of course, we saw that massive spike earlier in the year when the Russian invasion of Ukraine kicked off. Oil prices went up as high as about $125 a barrel, I think, but then they trended back down towards the $100 mark. But unfortunately, upwards pressure has maintained and prices have been steadily rising once again. And right now, WTI crude oil rose by about 2% over the last couple of days, and it now sits at $114 a barrel. And Brent crude oil is sitting at $115, which is not nice for us, not nice for inflation, not nice for gas prices or anything like that. Finally, then, we have the crypto market to look at, and what happened over there? Well, in general, it wasn't great, but it really wasn't awful either. Bitcoin had a very slight decline and is currently sitting just below $29,000. Ethereum fell by a little bit more, 3% on the day, and it's actually sitting below $1,800, which is one of the lowest points we've seen it at for months now. Altcoins were okay. Some of them rose slightly, like Ripple and Dots, as you can see, but most of them, the trend for most altcoins was, of course, downwards and not really by small amounts. Do Kwon, the founder of Luna Terra, is now officially going ahead with his Luna 2.0 plans, and frankly, I'm really not too sure about them. I don't think many people are. There is a lot of backlash against it. It does not seem fair, and frankly, we just all wish this charlatan would go and disappear. It is possible that this decline in the crypto market is still sort of a hangover effect from the Luna Terra collapse. Personally, I think it probably is, but there isn't really any data to support this. In general, if it isn't that, it's just general risk on sentiment decreasing and investors being a little bit scared of the volatility that the crypto market provides. So equities for the most part were strong for the day. Why was that? Well, most of it seems to stem from this idea that actually the Federal Reserve isn't quite as hawkish as maybe investors had priced in. Of course, we got minutes from the FOMC meeting from last month, so we got to see inside the scenes and see just exactly what the people who make up the Fed are thinking. And yes, in short, they aren't quite as hawkish. They're a little bit more dovish than many markets were pricing in. Now, what were the really important things that we saw? Well, the first one is here, that frankly, we're probably going to see another 2 consecutive months of 50 basis point rate hikes, but then from that point onwards, it's probably going to tame, maybe go down to 25 basis point rate hikes, or maybe no rate hikes at all. The reason this is seen as good by the markets and slightly dovish is because investors have been wondering about whether or not we're going to get 0.75% interest rate hikes, not 0.5%. And then the other thing on people's minds is, for how long are we going to see these 0.5% rate hikes? And well, 2 more months is not a lot at all. Many people were thinking this was going to go on for about 6 months consecutively, month after month after month of really quite strong rate hikes, maybe even with a 0.75% rate hike chucked in there as well. So yes, this is actually quite cool. Of course, we also had the Fed just talk a bunch of stuff about inflation being bad, which is blindingly obvious, and they're just making it known and discussing the ideas that, yes, inflation being this high is bad. Yes, they need to act to try and rectify that. Really nothing groundbreaking there, not really much to move markets with. But what was quite interesting was this idea here that actually they may well start selling off mortgage-backed securities as they reduce the size of their balance sheet. Why is this bad? Well, it would flood the market for mortgage-backed securities with liquidity. It would force prices down, and this could have actually really poor results on the housing market in the United States. As the Fed was buying up these MBSs, they were inflating the housing market, and this could be a pretty serious attempt to deflate the housing market, with lots of other things, lots of other news pieces and bits of data coming out showing that actually the housing market may have just peaked and we may be in a turn for a downturn. Then this isn't actually the nicest thing to see, but this isn't happening now. This is not something that we're going to see within a week or even within a few months, probably. This may be 6 months to a year away, so markets can mostly just ignore this for now. Now, one thing that is going to sound a little bit ridiculous, and reading this headline here, I will not be surprised at all if you think I've gone a little bit insane, but it's this idea that actually there are a lot of recession indicators blaring right now, screaming a siren. And one of them, one that isn't really the most conventional of all, is the idea that strip clubs are starting to make less money. And in particular, strippers on Twitter, on social media, are telling everyone that they're making less money. And in their experience, this is a sign of a recession. Now, this is the tweet in question. I know it's a little bit insane. It comes from someone called Reverse Cowgirl 69 and Bottis Lil Bimbo. In short, though, she's a stripper, and usually she would make an awful lot of money from stripping. But as the recession comes, as the downturn returns, basically when you enter a bear market from a bull market, the first thing people are going to stop spending money on are strip clubs, right? I mean, what other discretionary piece of spending do you have that you would rather see go when your food payments start to go up, when your rent payments go up? Of course, the first thing you stop spending money on is strippers. And so what we see, this is a leading indicator. And surprisingly enough, she's actually right. It maybe isn't something that you can easily gather an awful lot of data on. I imagine most strippers get paid in cash and don't really report their payments to the IRS. So it's going to be very difficult to find concrete data on this. So it is only an anecdote. I know it isn't exactly the most reliable source out there, but there are things like this coming out from all over the place. A more serious version of this whole leading indicator idea is something like truck drivers or warehouses. If you work in corporate real estate and you usually do a lot of work with leasing out small light industrial units or warehouses, well, you've probably noticed that actually that market has shifted and it isn't nearly as bullish as it used to be. And that's a leading indicator of a recession. Now, on to corporate news. We have a little bit to talk about for a few different companies. The first one is from Apple, of course, what is the most expensive publicly traded company in the world. I think actually Saudi Aramco may have overtaken that recently, but in general, it's worth trillions of dollars. It's absolutely massive. We all know Apple, and iPhones are, of course, one of its largest segments. And for the last 10 years consecutively, year over year over year, they've seen growth in their sales and their demand, seemingly forever. And it's been something that actually a lot of people have struggled to get their heads around, myself included. 2 years ago, I really was thinking, yeah, but how can Apple really grow their revenues from here on out? They're already so big, it doesn't really seem feasible that they can continue to grow at huge rates. But for a long, long time, they did manage to continue that growth. But it seems that they aren't expecting that anymore. Throughout 2022, Apple is not going to be producing any more iPhones than they used to because they are not anticipating a growth in their demand. And again, this is a recession indicator. It's an indicator that Apple does not believe that consumer demand is going to stay strong, and they are not bullish about the economy for the next couple of years. Now, Apple's share price did drop on this news when they announced it, but in reality, it recovered within a day or two. This news is actually just over a day old. The share price has now recovered. It isn't a major hit for the stock in particular, but it is an indicator as to where the economy might be going. Now, another major company that's having a little bit of turmoil, it's just seen a bit of a speed bump, is of course Meta, or as we will call it, Facebook, because I hate the word Meta. Now, what's this really about? Well, as you can see, the company is being sued by the District of Columbia's Attorney General for these breaches over that Cambridge Analytica stuff that came with the last election cycle in the United States. This really isn't very good for the company. It's bad news. They're going to be sued. We don't really know where it's going to go from here. If they are found guilty, expect a multi-million, probably in the $100 million fine, something like that. Maybe some curbs, some antitrust action, some limitations on how they're able to run their business in the future. In short, this is not good for the company at all. And on this news, the share price of Facebook did drop by about 7% post-market. But then yesterday alone, Facebook clawed back most of those gains. And as you can see, ended up rising by 4%. The interesting thing that comes from this will, in my opinion, be how this affects future elections. It was a very big thing in the UK as well as in the US. The big bit of controversy, as you can see here, is about how Facebook allowed this data to go into the wrong hands, to be used by politicians, by certain political parties to strengthen their elections. And in short, this was not allowed. It was illegal, but they allowed it anyway because it was very, very profitable for them. Now, finally, for news for today, we have just a tiny bit to talk about on Elon Musk and Twitter. There's actually been quite a few developments, so I'm going to take the whole thing and look at it all in detail later today with another video. But for now, as you can see, Elon Musk is planning to change his Twitter deal. Now, he's not changing the deal that he gave to Twitter. I want to make that clear. He's still offering the same $54.20 per share for every publicly traded share of Twitter. But what he is changing is how he's going to finance that end of his deal, and he's going to use more of his own equity, as you can see. Now, the reason this is important is because there's been a lot of doubt over the last 2 weeks or so as to whether or not this Twitter deal is going to go through. A lot of people have been doubting that Elon is serious about this for a long time now. Elon has maintained that he is serious, but that there are just a few kinks to work out. And as all of this happened, Tesla's share price started to fall, and that is what makes up the vast majority of Elon Musk's wealth. He used to be worth $300 billion or so. He's now, at this moment, I believe, not even worth $200 billion, and buying a $44 billion company is a very large part of his net worth. So obviously, there are some doubts as to whether or not he can afford this. This does make it seem, though, that actually he's worked out these changes that are necessary, that he needs to get the money together to go forward with this deal, and he's probably going to sort it out. And so as a result, Twitter's share price jumped on this news. As I said, there's a lot more to this story, so watch out for that video that's coming out later today if you want the rest of the inside scoop. But one of the big things is that Elon is now being sued by Twitter investors for supposedly manipulating the stock. In short, I'm not a lawyer. I don't know exactly where this is going to go, but I wouldn't be surprised if this does go somewhere. He tweets an awful lot. He's had trouble with the SEC in the past. He's made it very well known that he doesn't like or respect the SEC. And yeah, it seems like there may be something coming his way regarding this. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. They can help you protect your portfolio against market turmoil through fractional shares of art from world famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, a site that allows you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you think that crypto going down is a buying opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.